Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Al Chu. He is a portfolio manager at the Man Group, and they are the sub-advisor for the American Beacon GLG Natural Resources ETF, ticker MGNR. This is an active, equity-based approach to natural resources and a little bit different approach than your traditional commodities ETF that will rely on futures or fund of funds. We talk about the process, really begins with identifying commodity cycles and drilling down into specific subsectors, then finding the best companies in those subsectors. So Al and I had a great discussion. I think you'll find this a very unique product. And so without further ado, please welcome Mr. Al Chu. Hey, Al, welcome to the show.
Hi, Brad. Thanks for having me.
So before we get started, why don't we take a little bit of time, learn a little bit about you and a bit about your background.
Sure. I'm a portfolio manager at Man GLG. Now, that sits within the broader Man Group's discretionary investment unit. This is a alpha-focused alternative manager listed out of the UK. As a part of that, I lead the natural resources strategy out of the New York office. I've been investing in natural resources for a little bit over 2 decades now. And before Man Group, I ran the natural resources strategy at BNY Mellon and at various hedge funds. And it's been a really exciting past year because we were able to launch with American Beacon a natural resources ETF into the market.
Yeah, and we're going to talk about that explicitly today. Before we get too much into the business side, I always like to ask people, when you're not behind the desk, when you're not working, any hobbies, what do you like doing for fun?
Oh, yeah, I have 2 part-time hobbies. One is a part-time bank teller and a chauffeur. Basically paying for stuff for my kids and driving them around. So unfortunately, I'm about as boring as you can get.
Yeah, that seems to be the consensus for those of us with kids recently is the Uber to practice and friends. But
right.
So let's talk about the Man Group as a whole. It's an interesting business. So you touched on it briefly, but what all do you do to kind of help clients? And you do a variety of different things. So can you talk about the firm as a whole?
Right. The firm as a whole, I think there's actually a wide variety of strategies. I think the main cornerstone is that it's active management, and we are very focused on alpha generation. Products involved are things like mine, active commodity equities. We have private credit, a lot of fixed income. One of the biggest systematic strategies out there. So it really, I think, runs the gamut. And I think the cornerstone, again, really is alpha generation and delivering that value to our investors.
So I was actually reading on the website, you guys have a connection to the Oxford Research Lab, which does a lot of machine learning. We've just had on, some AI-driven strategies as well. So how are you, if at all, right, incorporating any of that data into your research or into your investment process?
Right. No, that's a great question. I think as the investment world has been changing, I think it really is a hybridization, right? Combining big data and kind of leading edge analysis. And I think Man Group has been on a lot of the forefronts of that, right? Because of the systematic strategies. I think we were some of the early adopters of big data. Even myself, where I run a very fundamental strategy and process focused on, supply and demand and company analysis. We are backed by, a very large team of data scientists with a lot of data that the firm possesses and just really cutting edge technology that helps with the everyday job. And I think it's that kind of evolution where I think we're really delivering a lot of unique excess, returns to investors.
So as part of and I know you're not on the systematic team, you're on the natural resources side, but are they allowing kind of that type of research to really run this entire strategy and evolve it, or there's still some kind of human inputs involved? Just curious.
Yeah, no, the strategy itself is all fundamental, right? I've been doing this for 20 plus years. And at the end of the day, I still think that, my opinion and my judgment would be the most important factor. But then again, it's that we do utilize every data that the firm gives us, right? It's a combination, right? We don't rely on any systematic screens or anything. It is, at the end of the day, data, human analysis, human judgment. But we do make it a very data-driven process, right? Meaning it's not, well, I feel like this is going to do well or not do well. It has, I like for my opinions and my decision points to be backed by actual data points.
Yeah. So the ETF we're going to talk about today is an American Beacon Natural Resources ETF. But can you talk about behind the scenes, like what does your role look like as kind of purely, sub-advisor and portfolio manager to a fund that's run kind of under somebody else's banner, if you will? Like what are your day-to-day roles and responsibilities as PM, and how are you working collaboratively with them to help get the fund out there, get it distributed, get it in people's portfolios?
Sure. So I manage it within Man Group. I manage a team of 3 analysts and myself that's directly works with this fund. And then obviously I'm backed by a big team of traders and data scientists and whatnot. American Beacon has been great partners. They're our distributor in the United States. I think one of the things that I really liked about them when I started launching this fund was that I view them as kind of the experts in active ETFs, right? Given their background with Cathie Woods and the ARC products, I think these guys have been way ahead of the curve and way ahead of the ball in terms of getting in front of the active ETF movement. So they've been fantastic partners. So Man GLG and Man Group, we do all the investing, running the actual portfolio, and then American Beacon helps us with the distribution.
Sure. Got it. So let's talk about the ETF, which is MGNR. It's the American Beacon Natural Resources ETF. At a very high level, can you explain the investment strategy and what this fund's really trying to accomplish?
Sure. So this is a long only equity product. There's no derivatives, no leverage. What we invest in is natural resources equities. Now, this is different from a lot of the other products that are in the market in that, one, it's an active ETF, right? I think a lot of the natural resources strategies out there are either passive or passive plus. And I think that is not the optimal way to invest in natural resources. And two is that this is, instead of investing in the underlying futures, this invests in the underlying equities, right? So for example, rather than investing in oil futures, this would invest in the oil producers or oil field services companies. And I think there are a lot of pros and advantages to investing in the equities that we can obviously hunt on later.
Yeah. So at it being an equities fund, which is a little bit different, can you walk us through kind of the investment selection process? How are you identifying investment opportunities? I know you kind of alluded that it was fundamental in nature, but can you kind of dive a little bit deeper into your investment process?
Sure thing. I think the cornerstone, the main tenet of this fund really is alpha generation, right? And I think being an alternative, asset manager, I think that point is really prevalent across. I think the investors tend to think of commodities as it's a broader beta play, correlation of one. There's no, it all goes up and it all goes down. And that really is just not the case, right? If we look at the benchmark, the S&P Global Natural Resources Index, or any benchmark, a commodities benchmark, you can use the BCOM index or GSCI. If we take the 1 year back, 3 year back, a 10-year back, through good markets, a bad market, and you separate out the top 50 percentile versus the bottom 50 percentile in returns, right? That dispersion of return on average is over 40%. Right, meaning there are huge winners and losers in commodities, and I think the last couple of years have been a great reminder of people. Right, through 2022, 21, 22 period, natural gas, double, triple, right, on very idiosyncratic natural gas issues. Right, pipelines, LNG, Russia invading Ukraine, petrochemical facilities starting up. And on the other side of that, during the same time frame, right, during the same economic systemic backdrop, right? Iron ore, the biggest metals by volume in dollar traded, was down over 50% at one point, right? And now that's alpha. So understanding the commodities, that supply and demand drives that dispersion return really is the first lever that we pull, right? It's a commodities first. Any given year, there's something that's going up, something that's going down. This year, gold has been a fantastic performer. Contrast that to oil, for example, another major commodity that has struggled all year. There's alpha to be generated from the commodities, right? Then the next step is really to take the next level of analysis, right? Is to pick the right subsector. Well, if you do like a miner, or if you do like let's just say energy, like what part of the subsector do you pick? You pick a producer, an oil field services producer, a tanker company, a midstream, because the pole position in returns really changes for the subsectors as well, right? If we recall, right after COVID, refiners was a big outperformer versus the rest of energy. And then you fast forward a couple of years later, then oil field services started outperforming. And then the final lever of alpha, the final lens really is just the bottoms up, going out there, kicking the tire, understanding the companies, right? Which companies have the best assets, best management team, best portfolio, the rate of change, right? And then when you combine all three of those, that really gives you sometimes very powerful drivers of performance.
So just kind of maybe oversimplifying that to make sure I have it right is you're looking for the commodity, favorable commodity cycle at the commodity level, then driving down even deeper to say, okay, which particular part of that, let's just use gold for an example, which particular part of gold is going to do well, and then identifying the best companies in that subsector.
That's exactly right, right? So we take more granularity because there is that dispersion, right? Sometimes we go into different regions, different assets, different parts of the supply chain, but that's absolutely correct. And I think it's that operating and financial leverage taken by the company that really can create excess returns.
So just about how many holdings is the fund, allocated to at any given time? I know it's active, but you kind of have a target, or can it go anywhere?
I take a fairly concentrated approach, meaning if there are 90 to 100 names in the benchmark, I run 40 to 50. Now each position, I don't let individual positions get over 5%. And then we don't concentrate into one specific sector, meaning you won't wake up and, say, oh, wow, everything's energy, right? 2/3 of a sector is the maximum. And then within a subsector, so let's just say metals will be a sector, won't be over 2/3 of the fund. And then within a subsector, something like copper or gold won't get over 25% of the fund. And then on an individual position basis, it's 5%. Because obviously coming from a alternative management background, risk management is paramount, right? I mean, that's one of the key tenets of investing is to manage your risk. And a lot of that is by don't overly concentrate. You want to concentrate to generate returns, or to put it where you have the most conviction, but you also don't want to put all your eggs in one basket.
Sure. Staying on waiting for a minute, I'm hearing that, maximum position size is 5% in any one name. I'm sure that doesn't happen. I'm sure you're not equally weighting every name at 5%. That's the maximum you're going to go. So how are you making those kind of minor asset allocation weighting decisions once you've decided on sector, subsector, company? Is that a conviction thing, data? How are you making that decision?
That's a great question. It's a combination, right? One is liquidity. It's rare to find a very small cap, illiquid name in the top holdings, just because again is that investing is all about managing the times you're wrong as much as it is about managing what you're right. So if we're wrong, we have to be able to get out. That's liquidity. That's risk management. Two is the conviction level as well, right? Oftentimes, getting conviction to a name is a process, right? It's a journey. It's not suddenly all the work's done, T's are crossed and I's are dotted, and there we go. Let's take a big position in, right? So you put a position in. It's kind of like a kind of a minor league baseball, right? It's a feeder system, right? You have a lot of potentials. It's a pyramid, right? You build a lot of positions. You build baskets of exposure. Right? A lot of times what we do is that when we do like a theme, we don't take one single stock. we take a basket of names, right? Because oftentimes, if you look at commodities, if an earthquake hits a certain area, whatever assets in that region will obviously not have a very good day. But then the other parts of the basket will do very well because that's how commodities work. So you want to isolate risks that you cannot forecast. So it is part of that, and that will be, that will also affect the different weighings in stocks. But it's also kind of the feeder system where you do take, oh, this is a good idea. We've done a lot of work on it. It deserves inclusion into the fund, right? And as the data points build for the case, it gets bigger. We can add to it, or sometimes we're wrong, and the data points are telling you get out. And that's part of running a disciplined, data-driven process. Is that the data doesn't lie. Human sentiment, human emotions will, but if you focus on the data, oftentimes that will give you a very correct path to up your bets or lower your bets.
And one more question on kind of weighting and where things kind of can get allocated. Is there any guardrails on regional exposure in terms of overexposure to US or Europe or wherever? Like, do you have guardrails on geographic allocation as well?
Sure. I try to keep this as vanilla as possible, meaning I love OECD, right? I love rule laws, very developed and very deep liquid markets. 80 to 90% of the listings are OECD, US, Canada, Australia, Western Europe. There is very little EM and no frontier markets exposure. This is one of those, I want to keep the risk as concentrated into the commodities and natural resources world versus taking something unintended like a sovereign risk for my investors.
So as you mentioned earlier, the fund is active. So how often is it? Are you looking at this daily, changing weights? I mean, how often are you, looking at different, shifts in the portfolio in terms of sector, subsector? Are you doing that weekly, monthly, daily? Like how often are you?
Oh, right. No, that's we review it daily. Obviously, that their data is nonstop, right? It's 24 hours seven. So if the thesis is developed, obviously we don't think a one data point is going to change everything, but it is a fluid market. In commodities, you do have to be active. You do have to be tactical because supply and demand changes. Does happen. So we review it on a daily, hourly basis, if you want to say. Typical turnover, though, is about 60 to 80%. And that really is just a function of, the commodity cycles, right? We're making various bets. Some work out, at different time frames. And then just natural trimming and then upping of conviction or lowering of conviction, but typically 60 to 80% because this is a very active strategy.
So you kind of mentioned it there as well, and which leads me into my next question, which is, commodities can be at times like fairly volatile. So like, how does the fund handle some of those volatile periods? And I guess as well, if there's nothing really that attractive in the marketplace at any time, like how would you get the fund to be a little bit more defensive in nature?
Yeah, I'll answer the last questions first, right? I think, my experience with the commodities world is that there's typically always something working. There's always a bull and bear market going on somewhere. So if I don't think there's something that's working, it's probably because I'm not trying hard enough. Typically, there's always something where, I think there could be alpha or there could be an interesting opportunity. In terms of volatility, you're absolutely right. This is commodities is not a trending low vol product, right? But that said, I think that volatility can also be, it's twofold, right? One is that it generates opportunity for active managers like myself. We don't shy away from volatility. Now, that said, though, my historical volatility is it's higher than the benchmark, but not meaningfully higher, right? It's a little bit higher than the benchmark because I am trafficking in large cap developed markets in investments, right? But a lot of times the volatility is what drives excess returns or excess return opportunities, right? One of my things I would probably not like to say would be just a trending market where everything works at once, right? Typically, volatility is something that I look forward for. Another one is honestly the I think the investor base have grown really sophisticated over the years, right? They understand that the same volatility that can be viewed negatively is also a source the low correlations that commodities can give a portfolio, right? That volatility is backed by alpha or idiosyncratic events, and most of the investors, I think, you manage it by sizing it, right? You're not going to run into a lot of investors say, hey, I have 50% of my holdings in commodities. Rather, it's a it's a hedge, it's a real asset exposure, it's a alternative asset, it's a low correlation asset. So it's managed through various ways and view various ways.
So let's back up and kind of look at commodities and natural resources as a whole. Like, what long-term trends or even like future trends in that space are you most excited about, kind of on the go-forward basis?
Sure. I think one of the things that investors often forget is that throughout the history of mankind, we consume a lot of commodities, right? Commodities just really doesn't really go down. If we look at a long-term chart of agriculture, for example, it's a pretty steady line to the right. Even if we look at something like oil, there are blips obviously during the credit crisis and during COVID, but it's a fairly like you say, trending line, right? We tend to eat more, drive more, consume more, build more. Everything is more. And if you look at the longer trend, is that gosh, over the next 2-3 decades, we're adding 2+ billion people to the world. Wealth effect is that they're going to want to emulate the developed market lifestyle, right? Yeah, if we look at one of the things that's been happening that over the last decade plus is that during the commodities downturn right after the China super cycle boom, is that people stopped investing, right? And typically most CEOs are reluctant to say, hey, what, let's invest in a 15-year developing a copper mine, or let's build a nuclear power plant that costs 20 plus years to take, or a refinery, right? I think there's a tendency for investors and for I think the common person to underestimate how much commodities we need and how much we consume. And that if you underinvest in something, eventually that undersupply will catch up, right? And commodities, believe it or not, it's actually a fairly, it's inelastic good. It's really hard to drive less, eat less, consume less. A lot of times it's that the path of least resistance is just higher prices. And I really believe that. I think a lot of the long-term themes, right? Decarbonization, reshoring, all of these things are underlying it's inflationary, and it will drive higher demand.
So, do you ever see a day where you would incorporate as things kind of transition into renewable energy, that being kind of a section of the portfolio you might be investing in, some of these companies that are their whole business is renewable energy? Like, do you view that as potentially an inclusion I know it's not a commodity, but as an inclusionary into the portfolio at all?
Absolutely. When I think about energy, I tend to think of it holistically, right? I think the misperception is that, well, energy is just oil or it's just natural gas and coal. Realistically, energy is everything, right? It's the food we eat. It's anything that powers us. So renewables, like, it's going to be an important part of the power stack of the energy supply chain going forward, right? Whether people agree with it or not, is that over the next however many years, renewables will gain more and more market share. It is going to be another arm, another leg of the energy stool. So we do invest in that, and then we invest across the supply chain there, right? Generation equipment, actual renewable companies, power companies. So we tend to look at the whole supply chain.
Got it. So if you're sitting down, you or your distributor, somebody, selling this fund, right? And an advisor has an already diversified model portfolio, how are you advising them or recommending that they use this ETF, or how would you even recommend that they, pull out a portion of the allocation towards commodity exposure?
Sure. One of the things I always like to do with somebody selling or distributing this product is, rather than starting off with this is a natural resources like commodities fund, is I describe the characteristics, right? So here is a very large liquid asset class, one of the most largest and most liquid in the world, right? It's a real asset class, low correlations, right? Very low correlations, not positive, not negative to both debt and equity. It's a positive yielding asset, right? This is one of the highest alpha generation potential that, like I said, mentioned earlier, and it's actually a very effective inflation hedge. And usually, when I list those qualities out, and it's in a very easy to invest, instrument. And when I list those qualities out, people are like, "Oh, that's great! What that sign me up? what is it?" And then it's like, "Well, it's natural resources ETF." And then they're like, "Oh, okay," and they really have to think about it. And each one of those points is actually does describe the natural resources ETF. A lot of times now, I think the investor base is getting smarter and more well educated, right? I think it's kind of the winding down of the traditional 60-40 model, where they're like, well, the more actually, if we add alternatives in or we add real assets in, it really does move the portfolio investment curve higher and a better level. So I think it comes from from various sources of funds, right? When people think about real assets, it's typically infrastructure or real estate, and increasingly people are realizing, well, commodities can actually add a very interesting component to that. Or a lot of folks look at it from a value perspective, right? If we think about the periods over the last several years where value strategies have worked, a lot of times if you disaggregate the performance, it's typically, well, their allocation to energy, materials, or financials. It's only a couple of sectors, a couple of drivers that really makes that asset class work. And I think the investor base is really starting to think, well, is there a more dollar efficient way rather than buying a basket of every value name out there? Can I just concentrate it in X? And then some people do use it as a geopolitical hedge, right? If we look at, I think one of the biggest, mega trends now is that we're looking at increasing geopolitical fragmentation, and that's domestic, foreign, and this shows no signs of abating. And if we think about, well, how do you hedge it, or how can you effectively invest in it? Natural resources is actually a fairly elegant way of doing it. So.
Yeah, and the other thing that makes your fund unique is that it's getting the exposure via equity, right? A lot of the other commodity funds out there, are either are buying futures, or they might even be fund of funds of commodities, right? So I think you even have a more interesting story to grab like a larger market share inside of a model portfolio, rather than it just kind of being viewed as like an alt, right?
Right. There are a lot of pros to investing in the equities, right? Oftentimes you get the same commodity correlation, right? A oil company follows oil. It doesn't really, the correlation is higher to oil than the overall market, but yet you do get some equity premium to it. There's always a dividend yields don't go below zero, right? So you always capture that potential 0 to positive dividend yield. For ESG concerns, it's easier to push for change and to manage and traceability from a company viewpoint versus a generic futures, right? And honestly, it's the alpha potential, right? The ability to pick subsectors, to pick individual stories when you write about the commodity. So the equity, I think there's a lot of elegance to it. In many ways, it's a very good mousetrap.
Yeah, well, Al, I really, really appreciate your time with us today. But before I let you go, where can people learn more about you? Where can people learn more about the fund?
They can, Man Group, our website will have the fund. I have a lot of literature on there as well, white papers and blogs that I've written on various topics. American Beacon website, the Resolute American Beacon website will also have a lot of the papers and then the filings and whatnot.
Well, again, Al, thank you so much for being here.
Great. Thanks for having me, Brett.